All right, hey guys. So I've had many questions from a lot of followers on YouTube and well, in the trading community as well that asking how to get started in trading FX. I know that there are a lot of information out there. You can check out investing.com, baby pips, just Google how to get started in trading FX. And there's all the information out there, right? But since everyone's asking, or since many people are asking, I thought that I'll put something together. It's not the A to Z encyclopedia. It's not everything that is out there and that you need to learn, but it's really the key things, right? The few key things that you would need to get started with. And also, this ideally is going to be a series of videos. I'll do it once a week, putting out there. The first one now is Forex Trading Basics. The next one I'm planning to do is Forex Psychology. Then we'll do fundamental analysis, we'll do technical analysis, and technical analysis we have candlesticks, we have looking at charts, looking at indicators, support, resistance, trends, all that put together, patterns, all that. And then also we'll look into some strategies, that trading strategies that you can deploy almost straight away, right? Those that I have tried and I have used, those that I have tried and forgotten and don't use as much. There's going to be a whole series of videos that I'm going to do over time, compiling it, sharing it with you guys. So again, as you're going through this, please remember you can help me out massively by remembering to click on that like and subscribe button. If you have any questions, put it into the chat or put it into the comments below. I will check the comments and the chat and I can answer your questions. And if it's something that you would like to see more, like more or different topics or anything like that, put into the comments or the chat, and I'll check that out. And in due time, I'll do that as well for you guys. Okay, so let's get into it. Forex trading basics obviously is your first step towards financial freedom or towards mastering this skill. So, again, it's starting to trade. Start trading like the pros, right? Start trading like the pros. Obviously, everyone starts somewhere. No one comes in, looks at the markets, and straight away you know what to do. So everyone starts somewhere. Even if you're a total beginner, I applaud you. I'm going to clap my hands. I applaud you for taking this first step to want to learn how to trade better, to want to learn to, or you're seeking better information. Okay, so ideally at the end of this session, you should know more than 95% of beginners, because I sincerely believe that if you are going to just be reading stuff online, um, it's good information, but there is always that little activation, or there's always that little insider tip or experience that is hard to share on a Word document or an article. um, I've been trading, and you guys have been following me on YouTube for quite a long time, hopefully. You all know that I've been trading for a long time. A lot of screen time, sharing with you my experience and tips and views, right? So uh, let's get into it, right? Get ready for insider tips, exclusive strategies that most beginners might miss. Now, obviously, what is Forex? The first question we have to ask or to answer is, what is Forex? The it stands for foreign exchange, all right? For as in foreign, X as in exchange. It's the act of trading currencies, global currencies, currencies of countries right across the world. So it's global. It is decentralized because you're talking about countries to countries. It's not fixed on one market like the New York Stock Exchange or the FTSE or the ASIC exchange. It's not one exchange, but it's global because you're trading currencies between, you're trading between currencies of different countries. It's the largest and the most liquid market in the world. $6.6 trillion traded every day. And through the years, this number has grown. It used to be, I think, about 3 trillion. Then it got to 5 trillion. Now it's at 6.6. And I've done many various versions of such a slide, and I just had to keep changing the numbers. So it's it's a huge market, and it's only getting bigger. In the past, forex trading was mostly done by financial institutions. The big hedge funds, the big banks, corporations, when they're buying currencies to take over other companies across the world, right? That was initially the main purpose of, well, one of the main purpose of foreign exchange. And obviously central banks dealing with the currencies, um, maintaining the value of their currency by, at sometimes, or some central banks would actively trade in the market, to reduce their supply or to increase their supply of currency and demand, just so that they can change the value of or manage, not really change, manage the value of their currency. So it was all before it was all about large financial institutions, corporations, and central banks that was dealing in FX. up until up until recently, and I think recently, like, I was trying to find a date, but I can't really find a date on that, where trading online on brokerage platforms became available and became easily available, where retail traders like yourself watching right now started looking into the FX market. Before that, mostly everyone was in stocks and equities. Then the liquidity and the volatility and the volume came into FX when it was opened up more to retail traders. Okay, so what is Forex? Forex is foreign exchange, is the act of trading currencies. Now, when we talk about trading currencies, you don't just buy one currency, right? You're always trading it in a pair. You're always trading in a pair because you might be holding the US dollar, you're buying the euro, or you're holding I'm in Singapore, so you're holding Singapore dollar against whichever the yen or whichever currency pair or whichever other currency it is. So you're always trading in a pair. And when we talk about currency pairs, there are the majors, right? There are the majors like the euro dollar, the Aussie dollar, the Kiwi, the pound, the US yen, the US CAD. Those are majors. Then we have the minors, the Aussie yen, the Swiss yen, the Aussie Kiwi, the euro pound. Those are minors. Then we have the exotic pairs. Exotic pairs are, in this case, the US, South African rand. We have, for example, the Singapore and Malaysian ringgit. All those are exotic pairs. For me, I like focusing on the majors. Right? I focus on the majors for the same reason that I've stated here, being that it's more popular, they have higher liquidity, right? They have higher liquidity, and very often they have smaller spreads. A bit less so now, but back in the day, definitely that they would have smaller spreads. Dealing with retail traders from all around the world, I do know that a lot of you guys like trading the minors as well, because often the majors, pound US dollar, euro US dollar, Aussie US, Kiwi US, US yen, Canadian US, Swiss franc against the US dollar. It's all based against the US dollar. So sometimes traders would like to look at the minors just so that they get away from the US dollar and they look at the Aussie yen or the Aussie Kiwi and the euro pound, just so that they have other things to trade, other instruments to trade when the US dollar is being a little bit crazy. Okay, but for me, I focus on the majors, I actually advise a lot of new traders just to focus on the majors first. Once you get that, once you understand that, once you've somewhat mastered it or got familiar with it, then you start exploring little bits of other minor pairs to look into. Okay, just quickly now, when you're looking at reading currency pairs, we always have it like the euro against the US dollar. Remember that the euro will be considered the base currency, the US dollar will be considered the quote currency, right? Then you would have the sell price and the buy price. Between the two prices is considered the spread. The difference between the buy and the sell price is considered the spread. Now, one big reason, well, the second big reason, the first big reason why a lot of people are super keen on trading in FX is because of the huge market, the liquidity, the $6.6 trillion traded per day. Second big reason is because the market is open 24 hours, 5 days a week. Like I said, it was decentralized. So 24 hours from Monday morning. Basically, from Monday morning, you can be trading all the way through to um, Saturday morning, right? Friday night, Saturday morning. So at all the times you can be trading. Obviously, I would say don't trade all the time. If you're trading all the time, something is wrong. Although, so I always like to say that although it's available, it doesn't mean that you have to do it. Okay, so it's open 24 hours, 5 days a week, which works perfectly for the global community. Whether you're based in Singapore or Dubai or the UK or Australia or the US, whenever you're available, whether you're working and available, whether whatever you're doing, when you're available, there's the market there available to trade. Four major trading sessions, basically in Australia. Firstly, Sydney. The Sydney market starts the first one because the day starts from Australia. So Sydney market starts with some volatility there. Then we have the Japanese markets in Tokyo starting. So we go from Sydney to Tokyo. Then it goes through Asia, called Asia session. Then we have the UK session opening in London. And then through that, we have the New York session, the US session opening. So four major trading sessions per day, every day. And the best opportunities arises when the sessions overlap, right? I mean, think about it. If the markets or when the markets are open in, the markets are always open, but when the trading session in Sydney, who else is awake? Not many, well, no one in the US is awake, they're probably falling asleep. Asia is waking up, the UK is still asleep. So liquidity is going to be predominantly from Australia, right? In Australia, and volatility might be a little bit lower. Then we come towards Asia. So you have Australian markets being open, you have the Asian markets open as well. You can have a little bit more volatility, but not a lot of news during the Australian and the Asian markets. The major markets are in the UK and in the US. So that's the lead up to the UK session where it starts, the London session, when it starts getting a little bit more volatile, a little bit more liquidity comes into the markets. And then we have the New York, the US session where you have a mesh, right? You have a mesh and it's all called the sessions overlap where New York and London overlaps. That's going to bring about higher liquidity and volatility because you got news from the euro, you got news from the UK, you got news from the US, and you got a lot, a majority of traders, whether it's institutions or retail traders, or just more people trading during that time. So higher liquidity, higher volatility. Now, the thing about volatility is, as much as to a new trader, it might be like, oh, wait, it's too volatile. Um, you don't want, new traders might be afraid of volatility. But if you think about it, trading or traders love volatility because volatility is when price moves. When price moves, it gives you greater profit opportunities or trade setups. The worst thing, the thing that I dislike the most is if prices are sitting right across. Right? If they're sitting right across, I've got nothing to do. I'm sitting there, I'm like, oh, I want to buy, but it's not doing anything. I want to sell, but it's not doing anything. But when volatility comes in, liquidity and volatility, you see it moving up. Then you go, oh, wait, it's going up. I'm looking to buy it up as it breaks a level. Or if it's moving down, I'm looking to sell it down as it breaks a level. So I like volatility. Traders love liquidity and volatility. But you want to be on the right side of it. You don't want to just enter trades for the sake of it. You want to be able to kind of think about it and follow that direction first off, right? Now that was market hours. Let me talk about how do you trade, right? We talk about how do you trade, and like I said right at the start, this is I'm not going through the A to Z. This is really getting right into it, the key points that you need to know. Ideally, once you get through this, you've got the main gist of it. Then all the other things you can add on as time goes by. So how do you trade? Basically, you're sitting here and you're thinking. Let me see if I can do this. There we go. All right. Right. Basically, you're sitting here and you're thinking, oh, I think the market. You could be thinking, I think the market is going to head up. Right. You think the market is going to go up. So you enter, or as it's going up, you enter a buy order. I know I'm messing up my charts now, not my slides now, but I hope you can still see okay. So as it's pushing up, you enter a buy order. You have the ask price. You get in at, for example, this price is a very old picture. So, and then your trade will be entered. So you get in there, your trade will be entered, right? You would have bought at that price. And then what you're looking for is for price to continue trading higher, just so that you can close out, or what we would say is, oh, I can't write, close out or sell it off so that you can make the profit here, right? Or on the flip side, if it's pushing down and then you think it's going to go down lower, you enter a sell market order. That's where you would sell, and then you're expecting it to drop lower so that you can make a profit. If you entered a buy and it comes right back down, then you're negative, you'd be losing money. Okay, so um, you can enter trades based on market order, which means that you're entering as price is moving. You get into a trade as the price is moving. Alternatively, you could be looking at this and you see it pushing down and you think, oh, this would be a great place to buy, right? But you don't want to buy it as it's pushing down. You want to buy it when it's come down and pushing back up at that point. So that's where you enter a buy limit order. So you put in an order to say that I would like to buy at 128.43 only if price goes down and bounces back up. I want to buy it there, not here. Okay, so buy it at this point, number one, not point number two at 128.43. So that's a buy limit. Then alternatively, it could be a scenario where you've done your analysis, you've looked at it and you say, right, price is sitting, well, it's pushing up, but it's sitting right across right now. I don't have time to sit there and wait for it to get to this point to get into a trade. So you could put an order in, an order to say, here's my buy stop. Okay, that means at 131.69 as price pushes up. Once it gets to 131.69, bam, you've entered the trade. It will automatically enter a trade for you. You're buying, you're looking for price to continue moving higher. It doesn't matter if even that happens. If it just spikes up, you would have got into a trade and it comes right back down, you'll be losing money. So make use of these very carefully where you're entering a trade either as price moves up or when you're looking for it to go down and then bounce back up with a buy limit, or a buy stop where you're setting a price in advance for it to break through and get into that trade. Okay, three ways to get into a trade. And I've talked about buy. You can do the same thing for a sell. You could put a sell order here, sell stop here, and if price goes down, it would sell right there. Or you put a sell limit here, and then if it goes right up and comes back down, then you'd have a sell trade in place as it would execute at that point. Okay. Now, again, remember, put it into the chat, put it into the comments. If you've got any questions, let me know. Then a few key terms. You don't need to know all the jargon and um, all the terms, but just to start off with, you would hear, and if you've been following me, watching my live streams and all that, you would hear me say pips, 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 30 pips, 40 pips. What is a pip? What is a pip? It's a percentage, that's why I got a P, right? Percentage in point. It is the smallest unit of price movement for a currency pair. It measures the price movement in Forex trading. Okay, so for example, if the euro dollar moves from 1.07802 to 1.0781, it's gone up by 1 pip. Not recently, but when you're looking at some platforms, they do sometimes have 1.07801. So it's not always the last number. We'll count pips as the fourth number after the decimal. The fourth number after the decimal. But if you're looking at yen pairs, anything with JPY, right? For example, the USD. I need to get a pen so I can draw on it. USD JPY, then you're looking at it maybe right now it is, let me check, 152.92, let's say that, right? So you're looking at the second decimal being the pip. So for the yen pairs, second decimal. For the other pairs against the US dollar, is the fourth decimal place. That's the pip. The fifth one is the um, micro pip or percentage. Can't remember what's it called. But it's not the fifth number, it's not the third number, it's the second on the yen pairs or the fourth on the euro, on the US backed pairs. Okay, so that's how you count a pip. Again, this is going to be recorded, or this is going to be uploaded onto YouTube. If you lose it at any point, watch it again. It's there for you guys. Then, as we talk about pip, the big thing about trading in FX is the leverage, right? Leverage allows traders to control larger positions than they could with their initial investments, right? If you think about it, if you just had $1,000 in capital, what could you trade, right? Well, you could trade, but you're not going to make a lot of money, right? You think about it. If you took $1,000 and you went to the money exchange, pushed it over the counter, came back a couple of days later, prices moved, and then say you took $1,000 US, pushed it across the counter for a pound. A few days later, you came back, you pushed the pound back across the counter to get US dollars. You might make a couple of dollars. You might make a couple of dollars at best. So that's when you're dealing with no leverage. You're just pushing cash across the counter. But when you have leverage, and a lot of brokerage, they offer a 100 to 1 leverage. With $1,000, you can control up to 100,000 in value, right? In value. I highlight the word in value, or underline the word in value, is because Sometimes when beginners think about it, they'll say, "Oh, I control $100,000. So if I lose that 100,000, I'm out $100,000." No, if you because of leverage, you got $1,000, you're controlling 100,000 in value. So you lose 100,000 in value, but that means that you've lost $1,000. Okay, so you leverage up by 100 times. Should you trade at 100 times, or you should trade the whole 100,000 in value? No way. Absolutely not. Again, that line that comes is because you have it doesn't mean you have to use all of it. Right? So you would want to have that leverage, but use only a portion of it, because leverage is that double-edged sword. It can magnify your profits if you do the right thing, but if you take a wrong move, or if the market just goes crazy, it might not be anything that you've done wrong. It might just be a news or something that happened that caused price to reverse against you. It will also magnify your losses. So that's something you need to think about. Don't go all in. It's not about all in. Trading is a long-term thing. Um, I know that new traders will think that, well, will first think that it's super easy to make money. Then you would realize that it's not, and then you'll go through all the hassle. The main thing that I do here, and I share here on YouTube, is to try and shortcut that whole process for you guys, sharing with you, telling you that it's not that way. It shouldn't be that way. Um, you don't want to go through that big swings. It's a long-term thing, right? So I've gone through the start where I've traded a lot. I've barely slept and traded a lot, and slowly evolved to the point where I don't have to enter that many trades. I will enter only good setups. I don't go all in. I will just accumulate wins, accumulate profits, taking tiny moves that add up to big wins, right? Using leverage properly, right? Accumulation. Now, so we had pips, we had leverage. Now we look at margin, right? Oops, can't draw it straight, but margin is the amount required to open a leverage position, right? So the brokerage will somewhat set aside, they don't take it, but they set aside a portion of your capital or your value whenever you enter a trade, just to protect that they can close you out if, in the worst case, it gets into that negative scenario or the massive negative scenario. So there's a 1% margin where you set aside 1% of the value that you have traded at, um, to protect the downside. Okay, so three things you need to remember is pip, percentage in point, measure of how price moves, leverage, 1:100 or 100 to 1, double-edged sword. There are brokerages, or there are platforms out there that offers huge leverage, 1,000 to 1. I've seen 500. I've seen 200 to 1. I've seen 500 to 1. I've seen 1,000 to 1. Just because you have it doesn't mean you should take it. Okay, I think 100 to 1 is reasonable because you don't have to use all of it as well. I think 200, 500, and 1,000 is way too much. Um, why they've done that is just because it's going to encourage you to get started. It's basically saying that, if you put in $1,000, you've got $1,000,000 in value. I think that's crazy. Um, there are also brokerages in some jurisdiction that have 20 times leverage or 50 times leverage. Um, to be fair, I think that's a little bit low. Um, that's a little bit low, especially if you want to consider that you're going to be reasonable, right? It's low, especially for people who are reasonable, because you're not going to take the full leverage as well. So you're going to take a portion of it. So it becomes, you don't have a bit of that flexibility. So I think 100 to 1 is almost a sweet spot to get at. Then we got margin, which is the amount that is set aside whenever you enter a trade. Then with that, there's the three key things that you need to know. Following on from that, how to calculate profit or loss. Okay, let's say for example, you bought the euro dollar, the euro against the US dollar at 1.0780. You bought it up, right? So you bought at that price at 1.0780. That's where you would buy. Then price went up, and at 1.0790, you sold it off, you closed off your trade. Right? You sold off and closed up your trade. So if you take 1.0790 minus 1.0780 divided by the pip of the fourth decimal place, you had a price movement or pip movement of 10 pips. With a leverage of 100 to 1, at 100,000, you would have maybe, not ideal, this is not the ideal, but this is based on easy calculations. If you entered a standard lot, you would have $10 per pip. So 10 pips at $10 per pip, you would have a profit of $100, right? And this move to the upside could take a minute, an hour. It wouldn't take days because it's only 10 pips. But it could happen at any period of time, right? And that's your $100 from that trade, buying the euro dollar up from 1.0780 up to 1.0790. Right? So again, to calculate how to calculate profit and loss is your sell price over your buy price times your trade size. Right? Sell price, buy price over your trade size, which is the standard lot, and how much, then you get your profit or loss. If it went against you, that'd be a loss. At this point now, I cannot stress it enough before entering any trade. Right? So a lot of times you see price going like that, and all traders think about is when. Now the big question mark is when can I buy? It's not. You shouldn't just be thinking about that. Right? You should be thinking of when can I buy and where is my exit going to be? Right? Where is my exit going to be? So if I buy there, in the worst case, if I'm going to lose money, where would it get out? That would be my stop loss, right? If I'm going to make money, where's my take profit level? And these stop loss and take profit are automatic levels. All right. These are levels that you determine when you get into a trade. You set your stop loss and your take profit, and it's there. Once price gets to that point, it will close you out automatically. In the middle here, you can choose to close out your trade manually. Right? So down here, in between these 2 points, you do it manually. Between for your take profit and your stop loss, you do it, it will be done for you automatically. So very important, don't just focus on where are you going to enter a trade. Think about where you're going to be exiting a trade if you're going to lose money, and where you're going to exit a trade if you're going to make money. All right. Again, there's no certainty. It's not 100% thing. There's no certainty. So you want to kind of cover the scenarios. Now, we talked about what's Forex. We talked about how to enter a trade. We talked about the three key words, terms that you need to know, and your stop loss and your take profits. Now, the worst thing that a trader or a person who wants to trade can do is to just go in and say, I want to trade now and I want to make as much as I can. If you're thinking that, tweak that, right? Change that mindset. Because if you're thinking I want to make as much as I can, you're never going to be satisfied. And if you're never going to be satisfied, you're never going to stop trading. And if you're never going to stop trading, you run into the scenarios of over trading, risking too much, burnout, tilting, not accepting a loss, all that kind of stuff, and you're going to lose. You're not going to succeed. So when I sit down with a student or a client or in a group, one of the first things I want to find out is um, what you need to know. Well, not what you need to know, but what's the goal? Why are you here? What are you trying to achieve? What's the goal? Right? So it's important to understand the difference between a realistic short-term goal and long-term target. Right? So short-term goal is to focus on, and this is what I would suggest, right? Is to focus on small, consistent gains. Small, consistent gains. For example, oh, I'm new to trading. I'm looking to earn 20 pips a day. 20 pips a day, 50 pips a day, 60 pips a day, whatever the number is. You test out your strategy, you kind of get familiar with it, then you would set your target. That's your short-term goal. Your longer term goal would be to say to compound those 20 pips a day over and over and over again into more significant profits or to more significant goals, like to grow my account by 10% over the next 3 months, right? Because short term goals, when you talk about earning 20 pips a day, you're not going to do it every day, right? You're not going to do it every day. Unfortunately, as much as we have goals, you're not going to hit your goal all the time. When footballers kick towards a goal, it's going to get saved, it's going to get missed, it's going to hit the bar, it's going to be a missed kick, and then sometimes they get a goal. So when you're looking at short-term goals to earn 20, 30, 40, 50, 60 pips a day, there will be days that there will be no trades. There will be days where no trades. What else? You lose. You get into a trade and you lose. So you don't earn 20 pips a day. There are days where you're just too busy and you're not looking at the charts, and you're not trading, right? So you set the goal, you set the aim, but you give yourself that flexibility. Then that's why you have your long-term goal as well. It's okay, day to day I might hit or I might miss my target, but in the longer term, hey, I'm looking to grow by 10% every 3 months or every 6 months. The thing that you want to think about when you're looking at goals or setting goals is it's not just about setting a goal or a number for the sake of it, right? You need to think about how much time you're going to commit to it, um, how much capital you're going to commit to it. You're going to think about whether it's something that you can achieve or not. Because yeah, great, I would love to make 1,000 pips a day, but market doesn't move 1,000 pips a day. So how are you going to make 1,000? Things like that. All right. So remember that 90% of traders fail simply because they fail to set realistic goals that lead to over trading, risking too much in one trade. Like what I said right at the start, if you come in and I've taught thousands of individuals, a bit like yourself, and I fear the most for a person when they come and they say, I want to make as much as possible, right? I want to make as much as possible. Then, I know immediately that they're going to be over trading and over leveraging and risking too much per trade. So think about it. Um, a lot of times, I'll jump to this part first, is that you might, if you're watching this after the fact or if you're at any point in time, pause it and think about your own trading goals and keep it SMART, specific, measurable, achievable, relevant, and time bound. Specific, how many pips? how many trades, right? I would be looking at 1 trade a day, 2 trades a day, measurable number of trades, right? How many pips, how many how many trades, or you know, achievable. Is it possible? Maybe you work 20, I don't think so, but maybe you work 24 hours a day. How are you going to enter a trade at any point in time? Right? So you want to set aside time, which is time bound. I would set maybe, so in this case, you'd say, okay, every day I will spend maybe 1 hour, right? I'll spend 1 hour per day, right? Looking at the majors. I know I'm terrible at scribbling. All right. Then I'll be looking at 1 trade per 1 trade setup to start off, right? Because you're just starting. Looking at a profit or a target of 50 pips, like that, something like that. Right? So you sit there and there's almost no stress that way. So you know, whatever time you have free, you come in, you turn on computers, you check it out, you go, okay, after 1 hour, let me just scroll through the major currency pairs and check price, where it is, where it's heading towards, what kind of levels I have. I'm looking for a trade setup. If there is one, does it, you know, my stop, if my entry is here, my stop loss is down there, my take profit is down there, does it fit with my goal? Yes, great, I'll get in. No, don't get into that, or get into that, but manage my trade, then turn it off, and you're done. That's your 1 trade. Okay. So again, remember that for a lot of traders, you aim for trades of 1:2, a risk reward ratio of 1:2 or 1:3, right? Which means that you're risking $1 in an example to make $2 or $3. Right? Why you do this is because you know that your win, let me write that, percentage is not going to be high. It's not going to be high, right? And if you're risking $1 to make $2, or you're risking $1 to make $3, your win percentage does not have to be high. It does not have to be high. Even at a 50% win rate, if you're risking 1 to make 2, you're still going to be profitable. There's so many professional traders and hedge funds and a lot of the names that you would know. They might have strategies that win 40% of the time, but they'll cut a losing trade quickly and they will hold on to a winning trade and let it run. So they risk small and it could make big upside. Okay, so understand that. Risk to reward 1:2 or 1:3. Then when you get more familiar, or you got a trading strategy on an edge that you are confident about, then you can go for a little bit lower, but you just need to back test and have good data to know what's your win rate on that strategy. The one thing that traders, or especially new traders, focus on is, where's my mouse, is trading strategy, right? Is trading strategy. But even the best trading strategy, if I gave you the best, I said, here's the best trading strategy for you, and it works for me, here it is for you, it wouldn't work for you if you cannot manage your risk and your money, right? If you enter the trade without stop loss, that's the worst thing to happen. If you enter the trade 2 times, 3 times bigger than what you're supposed to or what your capital can accommodate, the strategy is not going to help. Any winning strategy is not going to help. So always understand that risk and money management is so much more important than a trading strategy. It's the It's not that a trading strategy is not important. You want to have a good one, but you need to focus a lot on risk and money management. Fair enough? Then, with that, we come down to choosing a brokerage. You can check out the description section below this video. I'll have a couple of links there for you on brokerage that you can use. Um, do use the links there. I don't know how many I'll provide yet, but I'll provide a couple. Do use the links. It doesn't cost you anything extra. It doesn't um, affect your spread or anything, but it does support me doing this kind of videos. So I appreciate if you can use the links below. The thing with choosing a forex brokerage is that you want to do well. Firstly, I'll start from this point here. You have to test, check, and do your due diligence. What I mean by test is you register for a demo account first. Test it out. All right. Um, See how it works, how it enters trades, whether you like it or not. Check. Check by speaking to someone from the brokerage, speaking with other people who are using the same brokerage. Check. Get deposit money, do a few trades, take money out before you go big amount in there. Check the process of the brokerage. And that's the way of doing your due diligence. Because I can tell you that brokerages now, and I've been to so many expos, I've seen so many different brokerages from all around the world. They all pretty much offer the same thing. So what you want to do, first thing, check the regulation, right? Regulation, or the importance of regulation, or which regulation, also comes down to where are you located. If you're in Australia, you want someone that's ASIC regulated. If you're in Singapore, you want someone that's MAS regulated. If you're in the UK, someone that is FCA regulated. If you are in Europe, you'll be looking for someone maybe Seychelles or Cyprus, or um, I can't think of which Europe, what other places, but you want to check, right, whether it, the regulation covers you or not, or whether you're in the UAE, you want someone who is ESCA regulated, right? So you want to check that it's the regulation covers you or not. Then you want to check that the platform ease of use of the platform, whether you're using MT4, MT5, C Trader, Ninja, or they have their own proprietary trading platform. Is it easy to use? That's one thing to check. Then average spreads, right? So you get into a demo account or you register a live account, don't fund it yet, get onto the MT4, MT5, and then you're checking the average spreads. And I like doing this, and I'll suggest to everyone, the links are going to be there. I don't know which ones yet, but the links are going to be there. Sign up for one or two trading accounts across different brokerages, have both of them open, and then you can compare prices. This one gives me a 1 pip, or no, 0.1 pip spread on euro. This one gives me a 0.15 pip spread on euro. You can compare prices, average spreads through the day, just so that you know which brokerage is giving you a better spread, right? So you can compare the average spread. Then customer service, right? You're going to think about customer service where, if something happens, is there someone to speak to? Is there someone to speak to from the brokerage? Is it a chat function on the website that you can speak to them in maybe in a different language and ask for help? That's customer service. Or is that an account manager that you can speak to provide some assistance? And then very, very, very importantly is the deposit and withdrawal options and fees. How are you going to put money in? Bank transfer, payment services like Neteller, Faster Pay, that kind of stuff, or bank transfer, or you can do credit cards, um, or what else? Cryptocurrencies, all that. Right? You think about how you're going to deposit. Is it fast? When you click to deposit money, is it going to how quickly is it going to reflect in your account? Is it within a day? Is it within a couple of days, or is it within a week? It's never going to be a week anymore. Most brokerages are quite good to keep it within the day. So, depending on the method, between 1 to 2, 3 days, right? And then withdrawals. How you deposit is usually how you're going to withdraw. What are the options? And then are there any fees? Right? Are there any fees? There are most of the time, brokerages will not charge a fee most of the time, but then it's your bank that charges a fee for deposit and withdrawal for the transfer. You can think about that as well. Okay, so sometimes it's a benefit to using a card, uh, credit card. Sometimes there's benefit to using a bank transfer. Sometimes there are benefits on cryptocurrencies. For example, you're holding crypto, you can do crypto transfers as well. So all of that things to think about before you sign up for a brokerage. Like I said, brokerages will all a lot of brokerages out there. There are thousands of brokerages out there. They all say the same thing. They offer tight spreads. They offer fast executions. Um, Sometimes there are bonuses where you deposit X amount of dollars, they give you X amount of bonus. Credit to trade with. Be very careful about those. And like I was saying, be very, very careful about the too good to be true leverage. One is to 1,000 to 1, right? It's it's too much. It's just too much. So things to test, to check, and to do your own due diligence. You can check out the links again below to try to register for an account with any of the brokerages with the links below. Okay. Now, talking about demo accounts, right? Why I say just register and try a demo account. If you're new to trading, a demo account is essential. It's your first, well, this is your first step, but it's your second step before you start trading. Get a demo account, register with a brokerage, get a demo account, and practice before going live. What are you practicing? You're practicing whether you know what button to press, right? What button to press, where to click buy, where to click sell. Um, don't click the wrong button. How big a trade should you be entering? All those numbers. How to do your analysis, right? How to close a trade. I've seen so many scenarios where traders would click the wrong button, right? They would want to buy, but they click sell. They want to enter one standard lot, but enter 10, for example. Um, they will want to close out a particular trade, but close a different trade. So you want to test it out. That demo account is there not so much about proving that you can make money on a demo account. Yes, that's partly important, but it's not so much about proving that you can make money on the demo account, but for you to get familiar with the system, to know what you're doing, then to start trading live, right? Why I say it's not super important that you're trading on a demo account and making money is because when you're trading on a demo account, there is no emotional stress of losing, right? So very often, if you enter the trade on a demo account and it's losing, what do? Nah, it's okay. Leave it. Hold on to it. Let it run. Make money. Great. Look, my strategy makes money over and over and over again. But when you're trading live and it loses a little bit, you close out a trade. So it's not a true reflection. The demo account is not a true reflection of what happens on a live account when it comes to trading because there is no emotions involved. But if you are if you're disciplined and you have a process, it can help you build a habit, right? It can help you build a habit because you're back testing, you're testing the strategy and the approach to trading, just so that you have that whole system, SOP, your standard operating procedure, or SOT, right? Standard operating trades method that you get in before you get into a trade. So new traders, get a demo account, get familiar with the platform, understand the market behavior, look at how price is moving. Um, it's important to see how price moves, to get familiar with it before you trade. There are times where there are currency pairs that I don't trade just because I'm not familiar with how much price moves by. I'm not familiar with the market behavior of that currency pair, so I won't trade it. I'll spend time to analyze it before I start trading that. Like, that's why experienced traders would use demo accounts. So experienced traders would use demo accounts to try strategies and back test before risking real money. Okay? Then again, like I think I said just then, don't use demo accounts for more than a month. Right? Test it out, try this, try that, but don't use it for more than a month because you are going to be trading with it's not a lack of emotion, but it's no emotion. Right? If you're doing something with no emotion, no excitement whether you're winning, no excitement, no nervousness whether when you're losing, it just ends up in gameplay. I'm just in there clicking buttons. If I win, great. If I lose, hold on to it till I win because the market moves in a cycle most of the time. So it becomes gameplay and it ends up developing bad habits. I can almost guarantee I've been teaching people how to trade since back in 2012, right? So it's almost 12 years now. I can almost guarantee you that I've seen this where traders or people learning how to trade who use a demo account for more than 2 months, right? Who use demo accounts for more than 2 months don't end up trading live because they get so used to trading with no emotions, like they're playing a game. They find it very hard to transition into a live scenario. They end up developing a lot of bad habits because they'll just enter trades randomly like a game and just let it run and look like they're making money. But when it comes down to actually clicking with real money, they could freeze up. So use a demo account, not more than a month, then start a live account. All right, you start a live account, you always will start small, right? Think about whatever the brokerage is minimum is, use that. Yeah, brokerages with a $500 minimum, use that. Is 50, it's a bit too small. I would say, 2 to 500 would be a good starting point to start small. But understand it is first about the approach and not the money. At $500, if you're trading with $500 or $1,000, it's not about the money. Because if you're trading properly, if you're not over leveraging, if you're not over trading, you're not going to make significant amounts of money on $1,000. All right. But it's there to make sure that you've got the right approach with the right mindset, trading on real money. And when you're trading with real money and real emotions, it's going to speed up your learning journey beyond anything you can imagine. Okay, so very important. Demo account, not more than a month, then go live, start small. Not so much about the money, it's about the approach, about building that real money habit and risk management habit. Okay, so here are some, as you go through the demo account, as you go through the live account, here are some common mistakes that new traders will make. I've said this so many times already. First one, it's over leveraging. Right? When you're trading and you're risking too much, you might have $1,000 on your trading account. Ideally on a $1,000, your trade size would be 0.01. But a lot of people will be like, oh, 0.01, I make 10 cents per pip. That's not worth it. Then I go to 0.1. They try to make $1 a pip. That's over leveraging, that's risking too much. So you want to understand, right? Don't over leverage, don't risk too much. 2, emotional trading, making decisions based on fear and greed rather than logic. You see price rocketing up. What do? Oh, buy. Why? Because it's moving up. I want to get into that trade. Not so much on logic, not why is it moving up. You're just jumping in um, because it's moving up. Or you're in a position and it's losing and you're fearful for that loss. You hold on to that trade over and over and over again and it just keeps going against you. So that's fear. So you want to remove the emotion, or you can't remove emotion. You want to minimize or justify that with logic. And then this is the most important thing, right? Never ignore your stop loss. Your stop loss is there to stop loss. It's all in the name. It's there to stop loss, to prevent you from blowing out your account, from zeroing your account, right? So never ignore your stop loss. 90% of your success is going to be achieved by avoiding these mistakes. And there's a very common stat that 95, 97% of traders lose money in the markets. If you actually did look into that statistics, which I did, it's not so much that 90 however many percent of people lose money, right? It's actually interesting that 89% of traders were in a winning position when they got into a trade or after they got into a trade. They just don't close that out and then end up losing money. So it becomes over leveraging, trading based on greed and without a stop loss. Right? So put all that together and try and avoid those mistakes. Yes, mistakes will happen. And that's why it's called a mistake. But we want to minimize the occurrence of it and the frequency of it. Now, I want to just show you, right? We've just gone through this very quickly, just to get you started, just to get the gears churning. There's going to be a whole series of um, videos to come to support you through this whole learning process. But I just want to show you this to get an example of how you can enter trades, or how you can be looking at the markets and start trading, right? So the simplest trading strategy that I can introduce to you now is just by trend following, right? It's just by following the trend, and by number 2, understanding support and resistance. Right? So you're looking, basically what we're going to do is you're looking for price to move up. Once it gets to a resistance level, you're looking for it to break that level to the next resistance. You would say, okay, now that it's going up, it's broken my resistance. I want to buy here. My stop loss is going to be here. My take profit is going to be here. Right? Or if it's going down, then you want to look for it to break a support level, then you're looking to sell. You don't want, and we'll go into all the technical terms and more things to think about, and specific trade ideas and setups in subsequent videos. But just to show you an example, this is what we're talking about in terms of trend following and support and resistance. Okay, so I'll show you the example here. This is, I'll take that away. This is the US yen on the H4 time frame. You can see that price was going down before. Now if we zoom in right here, as it was going down, it's now found a new direction pushing back up, right? So that's trend. It's gone down, it's pushing back up. Then at this point now you say that I've got a level here, right? That's my resistance. I mean, assuming that you don't know anything else that happened here. As it pushes down and it comes back up, you'll be looking to buy at this point. Let's say I want to buy here. As it comes down and pushes back up again, right? It breaks that resistance. I'll buy it up. Where am I buying it up to? You'll be looking at firstly a level here, and then also a level, up here or up here. So now you'll be looking at this. As it pushes up, you say, okay, I'm buying at 146.45. My stop loss is maybe 100 pips. My take profit is 200 pips to the upside. And then what happens? There we go. And then it goes up. Okay, it goes up that way and it hits your 270 pips profit to the upside. Could even be almost 300 to the upside. There we go. That way, 300. Right? So you risk 100 to make 300 to the upside just by looking at this come down, push back up, retrace, and it pushes back, breaking that resistance towards the next resistance. Then as it sits there, so that's a trade. As it pushes right up again, you'll be looking at that saying, okay, now it's breaking up. I'm going to get in there. I'm going to risk 100 to try and make 300 again, right? And you're looking at that point there. So you could have had that 2 trades of 300 pips to the upside. This was on the 2nd of October. It closed out on the 10th, 8 days to make 300 pips. And then on the 21st of October, and it closed out on the 23rd, 2 days to make 300 pips again. That's really just a snapshot, right? It's not just like that, but it's just to give you an idea. If you're absolutely new to trading, that's just an idea of what you can do. Now, if you look at this, if you go further back, you can again now simplify it further. You see price going down, right? So we take all that away. You see price going down, assuming you don't know anything there, and you see that at that point, you have this level from where it was, right? And then you got the next level down here, and one more down there as well. Okay, so now you look at this again. As price is going down, you might not have done anything there, but once it breaks this level, you can go in and sell. You got a stop loss about 100 pips. Again, your take profit could be 300, could be 200 to the downside that way. Just down to the next line, right? Down to this, and you know why you have this line is because of this point here. Come down, close out, risk 100, make 200 to the downside. And this happens over and over again. So, as it comes back up, this is another example. It comes down, it comes back up, and then it comes back down. You see it breaking this level, right? And then you have another point down here, let's say, because of those 2 points. You'll be looking at it going, right, it's trading down, it's bounced, and it's trading down, it's breaking this level, this line here at 150, almost 151. Then you'd say, okay, now can I sell here? I'll risk 100 again and make 400 to the downside because of that line that I saw, or this level that I saw in February. So straight away, this would be a trade that you could get in on the 31st of July and get out on the 5th of August for 400 pips or $400 to the downside, right? So yes, again, very, very simplified view, just to show you an example of how you can trade just by following the trend, looking for price to break down from a level, break through a level. I always suggest to new traders, particularly to new traders, that you should be trading on the H4, or the H1 time frame only, right? If you're new, particularly on the H4. And when you enter a trade, you should never risk more than 2% of your account at any time. A total of 2% of your account at any time. Okay, so that's what we're looking at in terms of the strategy. You're looking at first trend, then you're looking at support resistance. You're looking at it on the H4 time frame. You definitely want to have your stop loss and take profit levels considered, and you don't want to risk more than 2% of your account at any time. That means you could have one trade, two, three. Well, don't have three trades at one time, right? One or two trades at a time. But if you have two trades, it should not, your stop loss level should not be more than 2% of your account at any point in time. Now, with all that said, it might be a lot of information. It might not be enough information for you at this point in time. This is just a start. This is just a start. There is going to be a whole series of information more to come. Please let me know if you are confused or if it helps, it clarifies a little bit. Just a quick information there for you guys. Now, with that, right, the things that I think you should do, the next steps moving after this video, is to firstly check the links in the description to register for a trading account. Whichever one you choose, that's fine. To make sure you like and subscribe to this video, like this video, leave a comment as well. Subscribe to the channel, because on a daily basis, I am going to be live. I think most of you know already, but I am going to be live streaming live 3 p.m. GMT plus 8, to share with you my thoughts of the markets, right? To share with you my thoughts of the market, just so that it supports your own analysis as well. Then the biggest thing that you can do to take your progress to the next level is to commit, right? To commit the next 20 days to trade or monitor the market in a demo account environment daily. Right? So what I mean by that is register for a demo account for the next 20 days, look at it, jump onto the daily analysis, get the information about markets as I stream live or watch the recap. Then check the video or check your charts on a daily basis. Just get familiar with it. Just get familiar with it. Understand how price moves. You could get into a trade or two on a demo account just to try it out. All right. The thing is that most beginners, I've seen so many beginners quit too soon because they get confused. Right? If you're sitting alone, trying to trade on your own, you get confused. You might enter a trade and it goes against you. You get discouraged or you get distracted by different strategies or different approaches or things on social media telling you that you should be making thousands and thousands of dollars every day. If it's too good to be true, we all know, take it with a pinch of salt. What I will always suggest is to join my training community, right? Where we have traders from all around the world, like-minded, who wants to improve, who wants to trade better, or they're supporting each other along this trading journey. The training community is on Discord. Again, sign up for two things. You have to sign up for the trading account and also my mailing list. which is going to be in the descriptions as well, where I will give you a whole series of things to do. One of them being joining the trading community, and that's absolutely free as well. So do make sure you join that. Okay, so like I said, please like and subscribe. Stay tuned as well for the next topics where we'll talk about trading psychology. Usually, everyone talks about trading psychology as the last thing. I like it as the first, almost the first thing to talk about because we get the mindset right. Once we get a mindset right, everything flows easier, right? Then we talk about fundamental analysis. I love fundamental analysis. It's all about economics, the data, what to look out for, what to pay attention to, what could happen. The fundamental analysis gives us the long-term view of where price should be heading towards. We look at technical analysis in terms of what's a candlestick, how to read candlesticks, trend, charts, support, resistance, indicators, customized ones that I'm going to share with you as well, all that. And then more detail. We just touched on the simple trading strategies, but more details of different trading strategies which are trend following using different indicators or price action, strategies which are going to be counter trend, which use different methods as well as news trading strategies, um, SMC patterns. Yeah, we cover everything, right, during all through different videos. Now, the last thing you have to do as well is to leave a comment. Let me know what you think about this video. Ask any questions if you have any questions. Suggest topics for future videos. Now, with all that said, I hope you found this informative and useful. I look forward to hearing more about what your comments and your questions and your suggestions. Please trade well, trade safe, and I'll see you in the next video. Take care now. Bye bye.